Welcome to our Quarter One Commentary Review. I'm Bob Baker, President of Advanced Asset Management Advisors, and joining me today is my business partner and AAMA's Chief Investment Officer, Phil Voelker. Thanks for joining me today, Phil. How are you doing?
I'm doing well, thanks.
Super. Before we get to it today, we thought a brief intro to Advanced Asset Management Advisors would be appropriate. We manage about $1 billion in assets under management and advisement. We're independent and fee-based, located in Columbus, Ohio, and we build and maintain a complete suite of risk-adjusted portfolios. We have ETF portfolios, mutual fund portfolios, and each of the series also have a global approach to them. We have some specialty portfolios, including our dividend growth portfolio, our multi-asset balanced portfolio, and our alternative portfolio. We place a high emphasis on accessibility and collaboration with advisors. And at any time, you have the ability of calling myself or Phil or Aaron Ploskow, our national sales manager. At AAMA, we have a deep focus on fundamental market pricing and sector valuation. And as we look at inflation today, and it seems like just about every advisor or strategist is talking about inflation today. And simply put, inflation is key to just about everything in the investment arena. It's key to interest rates, it's key to economic growth, it's key to corporate profits, it's key to stock prices. And probably most importantly, it's key to consumer sentiment, buying power, and the consumer's quality of life. So let's take a couple minutes and dive into those areas.
Sure. Bob, as you know, and any of you that have followed us over the last couple of years, we've been talking about inflation quite a bit, starting back in January of 21, and at which time we noticed clearly that M2 growth was at a record high of 24%, which is 4 times the average in the last 40 years. And as we said at that time, clearly inflation was baked into the cake. Transfer payments to individuals accumulated to $26 trillion over the baseline. As you can see on this graph, that the baseline trend is the dark trend at the bottom, and the green spikes are the transfer payments, which again is a cumulative $26 trillion. So when you put $26 trillion into the pockets of the population, a lot of that tends to get spent. Another factor in building the inflation scenario a year ago is that the Federal Reserve increased the Reserve Bank credit by $5 trillion cumulatively over its baseline historical trend. So fiscal policy and monetary policy combined to create the perfect storm of inflation, all at the same time that we had bottlenecks in supply chains, which of course has been a very favorite headline in any of the financial media. A lot has been blamed on the bottlenecks in the supply chain, but inflation has clearly been exacerbated with the fiscal policy and the Federal Reserve policy. The one thing that's a little bit different today, if we look at real interest rates, is that all of them are negative. You know, we've tracked up to $18 trillion at the peak of global debt that was trading at a negative nominal yield, not even just real yield, but nominal yield. We never dealt with that here in the United States, but certainly Europe and Japan did. But given current yields across any maturity, any quality spectrum, after inflation, real yields are negative. So the Federal Reserve policy of keeping rates low has repressed real interest rates. If we take a step back and just look at the volatility in the economy, we all know that we had record decline in GDP annualized rate of 30% in the second quarter of 2020. And then we had a 35% annualized gain a couple quarters later. So we had the biggest and fastest recession and the biggest and fastest recovery on record. So again, the volatility in the economy sort of follows the trend of the volatility in the fiscal and monetary policy. If you look at the arrow here, that's pointing to future estimates for GDP growth. And you can see it settles down. No economist is going to predict 10% swings in the economy. It all tends to coalesce around a sort of a consensus number, but it comes down to about 2% long run. So if we look at the trailing rate of GDP growth, the dark line on here is a 25-year moving average of GDP growth. And you'll see it peaked out in the early 70s at 4%, and it's been in decline since, dropped to 2% a couple years ago, and is again, based upon future estimates, going to approach 2% again. So both the 5, 10-year, same kind of thing. The 5-year spiked down, you can see, as a result of that second quarter of 2020. But all three numbers are very quiet going forward at about 2%, which, if we didn't have inflation, would be a pretty nice environment. If we look at corporate profits, we had, just like we had in GDP growth, we had a big drop in 2020 and then a big increase in 21. Currently, the projected corporate profit growth for the full year of 2022 is 8.5%. That number was 9.5 at the beginning of the year, so it's come down a touch, but it's getting back to normal, I'd say. So looking at corporate profits, and one of the reasons it's come down a little bit since the beginning of the year is some of the headwinds, obviously, with inflation, rising labor costs, material costs. And we've got certain raw material input prices that are up 25 to 50% over the last year. So depending upon how corporations can pass those along will determine its effect on the corporate profits. So we're in an environment where companies and sectors will be more and more differentiated by their ability to pass pricing along, as well as future spending patterns. So as the consumer spends more and more on necessities, they will spend less on discretionary items on the margin. So again, a differentiation for sectors. For example, consumer staples, even though it's a much safer sector historically, it's favored over discretionary because of the marginal decline of discretionary spending we would expect in an inflationary environment. So looking at the stock market, as Bob said at the beginning, inflation is key to a lot of things: interest rates, GDP growth, corporate profits, and also stock prices. Stock prices have been elevated on a fundamental basis for some time and continue to be elevated in the roughly 90th percentile on price to expected earnings. So what's happened in the last year is we've seen a decline on a relative basis of a lot of the more speculative segments of the market. So this is just an example. If we look at the SPAC ETF, which is a tracking of all the SPACs that have been issued, we can see it topped out roughly a year ago and is down 48% from that high, whereas the S&P is within 4 to 5% of its all-time high made in early January. So the longer the duration of the expected earnings, the more weakness we've seen in asset prices. So the SPACs have maybe no earnings today, maybe none expected for 2 or 3 years, and who knows what the future is going to bring. those type of assets have suffered significantly. You can also look at IPOs, you can look at the ARC, new innovation issues, any measurement of the more speculative segments of the market has been much weaker. So in summary, the stock market as measured by large cap stocks is still overvalued in our opinion, and the places to be are the more defensive areas, but we don't want to give up entirely on some of the higher growth areas because there's a lot of segments of the higher growth area that do have pretty good insulation from inflation and pretty steady earnings growth. You know, Microsoft, for example, in the technology sector used to be a very volatile stock. It's much less so today because of the consistency of their cash flow and their software as a service type business that they've moved into in the last 10 years. So more defensive look at the portfolios or more defensive character in the portfolios, but not giving up some of the growth segments entirely. So one of the things that's hot topic in everybody's minds today is the war in Ukraine and its impact on commodity prices, in particular energy. We'll see more about food later. I'm just going to put these other up here. Russia had been providing about 8% of our imported oil, or our total usage. So it's not a large component. It does have an impact when we stop that. But there are other sources, Canada, domestic drilling, and other OPEC members. So the impact of removing Russia, while it is inflationary on a global basis, is not a significant factor in America's price. Energy inflation historically has been short-term, and as cycles change, meaning drilling, exploration, etc., that has a tendency to fall back as far as an inflationary impact. Longer-term components, labor will certainly impact inflation. Rent and housing-related items are 41% of the CPI. So we're just now starting to see an increase in rents based upon the huge increase in housing prices we've seen over the last couple of years. That takes a while to filter into the inflation calculation with about a 1-year lag. So bottom line is that we don't see inflation falling back to a 2% target anytime soon, in particular because of the rents and labor factors. Even if the energy were to be flat for the next year, rents and labor are most likely going to be a driving force to keep inflation relatively high. Computer chips, automobiles that depend on them, those are supply chain issues that have been an influence in pushing prices higher in those markets. But again, those tend to be self-correcting, sort of like the energy sector. What we think is probably most significant to keep an eye on long term is the trend towards globalization that has, we think, now been reversed. And this started a couple of years ago during the pandemic, where health authorities couldn't get masks delivered quickly because they were large percentage of them were being made overseas, and it was just hard to get them shipped. So making healthcare protective equipment and masks domestically is going to cost more. So long term, it's a very, very tiny but persistent positive impact on inflation. So just think about, in the 1980s, the board of directors of Ford Motor Company sitting at their quarterly meeting saying, gee, when are we going to get all of our water pumps sourced out of China or wherever, because they're a lot cheaper. That was the trend back in the 80s and 90s and even the 2000s. But today, you could imagine a quarterly board meeting where they're saying, gee, when are we going to get our computer chips sourced domestically? Because we can't get them from overseas. So we think that the trend away from globalization has started. It's not going to change overnight. It's a long-term trend. And depending upon how some of the international relations develop, how long the sanctions are on Russia, whether or not other countries get sanctioned, are all factors that are unknown at this point in time. But clearly, deglobalization will provide a higher level of inflation going forward. So having talked about inflation developing, and we've talked about this for a year and a half, we've kept a very high quality short-term maturity structure in our bond portfolios, which has survived the bond market weakness relatively well. We've not avoided it 100%, but our shorter maturity schedule has certainly helped cushion the loss in bond prices. And I mentioned earlier, the equity portfolio structure, definitely large cap focus, definitely making sure that all the defensive sectors are represented and some overweighted, in particular healthcare. If we look at the two major differences in our portfolios versus the index, healthcare is a large overweight, financials is a fairly significant underweight. Healthcare had been underperforming the market, it's starting to improve, but healthcare is the only sector with below median valuations and above market earnings expectations for this year. So it's a pretty clear, and it's lower volatility, so it's pretty clear overweight for us. Financials, not terribly bad on evaluation, but earnings projections are not impressive at all. And financials were relatively strong in anticipation of the yield curve steepening, but with what's happened in the last few weeks, the yield curve has flattened and actually inverted on a few places. So the financials are starting to underperform once again. So those are the two major allocations away from the index in our portfolios.
Bill, thanks for that great review of inflation and the components we're looking at in our portfolios. In the future, we plan on reviewing our market commentary quarterly. So if you've enjoyed listening to this today, we're going to continue this going forward. And we appreciate your interest in Advanced Asset Management Advisors. As I mentioned earlier, Phil and myself are available to talk about our thoughts and how we're allocating the assets within our model portfolios. You can also speak with Aaron Ploskow, our National Sales Manager, and we welcome the opportunity to answer your questions and talk about the markets. Phil, thanks again for the day.
Absolutely. Thanks everybody for listening.